Hi everyone, welcome to my channel. My name is Shang, and I help companies think through their biggest strategic and operational problems. These days, there seems to be so much confusion and frustration about what is going on in the markets and the economy. From Feb 19th to March 23rd, the US stock market had its biggest crash ever, losing about 34% on the S&P 500. And then over the next 3 days, it gained about 18% of that back, and it just kept on going. Now we're back up about 28% from the March 23rd lows. And the situation, frankly, on the ground hasn't actually gotten much better, with over 26 million Americans out of a job. This by itself isn't all that surprising, because the market is always future-looking and reacts more to uncertainty than bad news. But last week, my thinking around this actually changed when my investor friend Daria Danielina forwarded me 2 memos from Charlie Munger, Warren Buffett's partner, and Howard Marks, the chairman of Oaktree Capital. And both of them sounded so uncertain and cautious about the future. And this contrast between these 2 top investors and the confidence in which the market was moving got me really curious, and I started digging. So in this 2-part series, we're going to cover what caused the crash in the first place, what the government's been doing about it, what's given the market so much confidence, and what could make Mr. Market throw another fit. Before diving in, I do want to let you know that my intention is not to give an opinion about why the market rose or fell, because in reality, there's so much going on, so many factors that nothing really stays current for long. Instead, I want to use an exceptional event to illustrate some of the fundamental ways in which the markets and the economies work. Just like how people study the Great Depression or the global financial crisis, I think there's a lot that can be learned from the COVID-induced recession that we're in. You'll also hear me use the term Mr. Market to symbolize the stock market. The term comes from Benjamin Graham's 1949 book, The Intelligent Investor. Graham was Warren Buffett's mentor, and he used Mr. Market as a hypothetical investor who is usually rational, but is prone to panic, euphoria, and FOMO. And because the stock market is made up of human investors just like him, the stock market as a whole takes on some of these characteristics. Lastly, I want to give a shout out to my buddy Rajiv Alufasan, who works on Merrill Lynch's private wealth management practice, for providing me the investment reports that formed the backbone of my research. Thanks to him, I didn't have to go too deep into the media cesspool. All right, let's get started. First, we need to back up to why the market crashed in the first place to better understand what makes Mr. Market so afraid. When the possibility of a national shutdown and the literal freeze of the economy became probable, it presented some huge uncertainties about how bad the economy could get. So some of the biggest fears were: 1, unemployment. If COVID forces the government to lock down the nation and put the economy on ice, it would stop the flow of money from buyers to sellers on a massive scale. Without revenue, companies would downsize and lay off employees, causing a huge spike in unemployment. Depending on how long the unemployment lasts, people can come out of this lockdown without any savings and with a negative outlook for the future, leading to less spending and borrowing, which slows down economic activity and recovery. Number 2 is liquidity crisis. Liquidity refers to how easily an asset or a security can be converted into cash. At the heart of this is the ability for individuals and companies to raise cash by taking on debt in the form of credit. A liquidity crisis arises when people make a run on banks to meet short-term financial obligations and survive an economic downturn. During this period of heightened demand for cash, banks hit their reserve limits and run out of capital to loan. And because so many non-financial businesses rely on cash from short-term loans to meet their short-term payments, it causes a ripple effect across the entire system as other businesses can get paid. If the economy were a human body, then cash is the blood, the banks are the heart, and a liquidity crisis is a heart attack. Number 3, This ripple effect can cause defaults on loans and bankruptcies. If a company going into this recession is highly leveraged, which is another term for having a lot of debt, and cannot make payments on those loans, the company might actually default on those loans, which would damage the financial system even further because the banks would not be receiving the cash that they had landed out. And if companies run out of cash, either because they can't borrow or get paid by their customers, they go bankrupt. The longer this cascade of defaults and bankruptcies continue, the harder it is to recover because people won't have a company to go back to work to after the lockdown ends. The possibility of this scenario happening ripped through the investor community. Mr. Market, who always uses past data to inform his vision of the future, suddenly had no prior experience with a pandemic-caused seizure of the economy. One other contributor to the market crash is the oil price war between Saudi Arabia and Russia in March. Well, I won't go into too much detail on this one because we're mainly focused on COVID-related impacts, but it is important to know that the US has become the largest producer of oil in the world since 2018. So our economy is very exposed to a simultaneous oil price war and a sudden drop in global oil demand, which caused the biggest oil price crash in the past 60 years. I'll cover some of the impacts on economic recovery in part 2. So with all said and done, Mr. Market was staring into the abyss. And what does the abyss look like? Well, our best example of the worst case scenario is the Great Depression of 1929 to 1933, where the quantity of goods and services of the US fell by a third, unemployment grew to 25%, about 7,000 banks failed, and the stock market lost 80% of its value. So yeah, Mr. Market had some pretty good reasons to be very scared. And this, my friends, is where the government comes in. And man, did they pull out the big ass guns. I won't talk about the CARES Act too much because I feel like the media has already beaten the death out of it. Also, its direct impact on the markets is pales in comparison to what the Fed is doing. All Mr. Market wants to know from the Treasury and Congress is that Main Street is taken care of so that people can go back to work and still be in the mood to spend money after all of this is done. What I will cover briefly is the rationale behind the size of the stimulus package, which isn't really a stimulus package at all so much as a simulation of a working economy while we're all frozen so that we don't fall into depression. The package is designed to directly counterbalance a 3-month or 1 business quarter economic shock. It's estimated that a massive lockdown will crater the quarterly GDP by up to 30%, about $2 trillion. Which is roughly the same size as the stimulus package. Looking at it another way, the total labor compensation in the last quarter was about $2.9 trillion. And in the worst case scenario of 20% unemployment, this adds up to about $580 billion of wages, which is very close to the $600 billion carve out for individuals. It's also interesting to note that the estimated GDP and unemployment damage is comparable to that of the Great Depression, which is our worst case scenario. Alright guys, ready for the fun part? Because we are about to talk about the Fed. The Fed brings to the table an unlimited supply of money. Traditionally, the Fed controls the market by lowering interest rates and encouraging businesses to take on more loans and borrow under cheaper rates, and investors to seek out higher returns by putting their money in the equity markets rather than keeping them in securities. The Fed can also pump money into the market by buying up government-backed treasuries and mortgage-backed securities. And this is exactly what the Fed did when it lowered interest rates to near zero and started buying securities at a mind-blowing $125 billion a day. To put that in perspective, the Fed was basically buying more in one day than it did in the entire month during the global financial crisis. This figure has since dropped down to about $40 billion of assets per day, but still, that is a staggering amount. If the pace and the magnitude of the Fed's buying spree was not surprising enough, it's also expanded its range of powers on where it can inject money into. Normally, the Fed is only allowed to buy up government-backed debt. But by invoking Section 13.3 of the Federal Reserve Act, it can go Superman and start lending to riskier parts of the economy through a special purpose vehicle, or SPV. So I'm going to go through a very short description of the Fed's main programs, because each of these can literally take its own video. So let's blast through these. Number 1, lending to companies by buying commercial paper, or CP. So commercial paper is a form of unsecured debt that companies typically sell in order to get funding to meet payroll or any payments that are due within, let's say, 30 to 90 days. Number 2 is lending to financial institutions that buy commercial paper. There's a bit more to this, but it basically allows companies to more easily sell commercial paper, hence increasing market liquidity. Number 3 is lending to companies by buying up investment-grade corporate bonds and helping investors sell these bonds in secondary markets. Number 4, lending to the primary dealers of the New York Fed through the Primary Dealer Credit Facility, or PDCF. These primary dealers are banks and other financial institutions that deal directly with the US government and then can use that money to buy up a wide range of securities, including corporate debt, commercial paper, munis, and even equity securities, aka company stocks. Not only that, the program will continue for as long as needed. This is definitely one of the Fed's most open-ended programs and could turn into one of the most controversial ones depending on who it bails out. Number 5, make US dollars available to foreign central banks through the foreign exchange swap lines to increase global liquidity, because so much of the world's debt is actually in dollars. And because what's happening in the US is pretty much happening in all the global economies, we can expect this money crunch to be happening just about anywhere. Most of these programs are taken directly from the Fed's global financial crisis playbook, just at a much bigger scale. The Fed is even willing to bail out city and state governments and buying up junk bonds of companies with poor financials. Junk bonds, or officially known as high-yield bonds, are so called because they're issued by companies who are more likely to default on them. In the world of security ratings, junk bonds are rated BB and below. For now, the Fed has limited its purchases of junk bonds limited to BB, which is basically the best of the junk, aiming to bail out companies that were recently downgraded because of the crisis. Still, this is an unprecedented move that's caused a rally in junk bond markets and generated plenty of fun headlines. As you can imagine, there's potential for moral hazards to be created because the Fed's broad strokes might be bailing out businesses that took on too much debt during the good times and now crashing and burning during the bad. This causes all sorts of distorted incentives in a free market system. And as Howard Marks eloquently put it, capitalism without bankruptcy is like Catholicism without hell. Alright, are you dizzy yet? Because all of this was done in 1 week, whereas it took the Fed several months to put it together back in 2008. And the full display of the Fed's powers is the key reason why Mr. Market feels so safe. Alright, we're going to take a break here because we've covered a lot. In part 2, we're going to see why the market has bounced back so quickly and what could bring it back down again. If you found this video helpful so far, it would be fantastic if you can hit that like button because it does help out this channel a lot. I will also love to hear if you have any questions in the comments below. Alright guys, I'm going to see you on the other side.